Hello, hello. Let's get everything set up here. So tonight's webinar, let's go ahead actually start on. I'm just going to try to stream on TikTok too. Let's see if it works. From the feedback that I've gotten over the last few webinars, you guys prefer kind of when I go off the cuff and we just kind of make stuff up as we go. I have a general idea of how I want to attack this webinar. So we're going to make the content as we go. It's more interactive. It's more fun to watch. It's not just me preaching off of slides. But I will preface everything that we're about to talk through with a very important fact, and that's that some of these concepts are very hard to simplify. In a world that is all about short attention, flashing lights everywhere, you got TikTok that shows like a podcast underneath, and then up top is like a truck driving through a maze to stimulate that primal short-term attention span going on. Like some of this stuff in trading, you just got to suck up and learn. And there's edge in that, in patience and learning and time. A lot of guys don't have that nowadays. So although we're going to talk through some of this stuff and make it kind of fun, hopefully more interactive, a lot of this stuff is just things that you're going to need to understand, you're going to need to learn, you're going to need to incorporate into your trading in order for you to be able to be more consistent and hopefully at some point, if you're not already, become profitable. So if you're joining on TikTok, I'm not going to be watching TikTok whatsoever. Just very rarely am I going to occasionally glance over. So if you're talking on TikTok, I'm not going to be able to see what you're typing. If you want to type and have me answer questions, go to the YouTube link. I don't even know if it's in the bio anymore. I haven't used TikTok in months. But find the Trading Initiative on YouTube, and you can watch it there and type questions. So let's go ahead and get started here. Excuse me. The first thing I want to talk about, let's see, risk to reward setups. So let's actually go to TradingView, and I'm going to draw out some stats here for you guys. So generally speaking, move my coffee, a higher R to R, right? Your higher risk to reward, meaning for every dollar that you're risking, how many dollars are you looking to gain on a position? That's what R to R stands for, obviously. A higher R to R generally entails a lower winning percentage, but a higher reward, right? We understand that that's generally agreed upon. If you're batting for higher risk to rewards, if you're only betting $1 to make 8 or $1 to make 10, generally speaking, you're going to have a lower winning percentage. But when you do win, hopefully the wins are going to pay for all of your losses and more. There's a lure to that, right? It's not just because people like to have lower winning percentages. It's that when they do win, they're generally very large. Conversely, if you're looking at a lower R to R, so let's say like a 1-to-1, 2-to-1, if you're scalping like a 0.25 to 1, a 0.5 to 1, you're going to have a higher winning percentage, or you're going to need a higher winning percentage, but you're going to have lower rewards. So I want to start off this entire webinar by stating that this part right here, the winning percentage, that's like where you need to start. Specifically, if you're swing trading, day traders, they can go 2-to-1, 3-to-1, etc. Scalpers can go obviously below 1-to-1. If you're targeting 3-to-1 or better, anything above a 20 to 25% win rate, theoretically over a large sample size, is going to be profitable. And I'm going to prove it to you in a second. So your win rate is going to be a product of the risk to rewards that you typically target. So if you're looking to risk $1, and for every dollar you risk, you want to make 4, anything over 20% win rate, theoretically, is pure profit. Now, I say theoretically because we all know stats, and if you're an economics degree holder or going through the major, models are great. But generally, models are for educational purposes, and we know how different things are in real life. If you've gone through college, I'm sure you've heard something about the efficient market hypothesis. The Dumbos in the 70s thought that all information in the markets was readily available to all market participants, and therefore price is evenly distributed across the market because all speculators have access to the exact same information, so it's efficient. Well, what we've noticed at the very minimum over the last 15 years is that there is a very big gap, particularly because of technology, based off of where the information is coming from and the market participants that have it. There's no better chart to show you that this is not an efficient market than something as stupid as GameStop. Right? GameStop's huge run going back to 2020/2021 should prove to every single person still preaching efficient market hypothesis that it's just not real. And now you have things like Nancy Pelosi tracker, etc., showing that there's just not the information war is very heavily skewed in favor of the insiders, if you will, right? So this idea that efficient market hypothesis and everything is going to work out is just complete bullshit. And so these higher risk to reward models that we're looking for, in my mind, remember, these are models and theories. Over a large sample size, if you're going 3-to-1 or 4-to-1, which is generally the status quo inside of TTI, we actually won't take anything less than 4-to-1 because your average winning percentage has to increase. So let's actually go through that really quick. One thing I will say is if you find somebody marketing a high win rate, we'll say 90% plus win rate, and they're always posting like 100% plus wins, just ask yourself through the power of compounding if that is logically possible that an asshole can pull that off. That's all I'm going to ask. Just use basic arithmetic. These guys would be trillionaires in 6 months if they were returning 100% plus wins like you see on FinTwit and TikTok and YouTube, if their win rates were really this high. That's not how trading works. If your win rate is this high, it's because you're taking smaller wins, which is fine until you inevitably take the loss, and then it wipes out a bunch of those wins and you get back into it, right? So let's talk through this really quick. Let's talk about break-even win rates. So we were just talking about 3-to-1, 4-to-1, etc. Let's say, for example, for every dollar you risk, let's start with scalpers, you're looking to make a $0.50. So 50 cents on every dollar that you risk. Your break-even win rate has to be 66%. Otherwise, you are not profitable. That is just the base case. Everything works out perfect. You have to win at the very minimum 66% of your trades. Most people don't target 0.5. If they're risking $100, by the way, how many Discords and other types of traders, like trading groups or whatever, do you see somebody go, I bought 0 DTE SPY calls, I paid $100 for them, and I'm out for 17%. Great trade, good trade. So you were willing to risk that full $1 to make 17 cents, or should I say $100 to make $17? Your break-even win rate has to be 85.5% over a large sample size when you chase stupid trades like this in order to make money. This is, by the way, a huge reason why people that day trade and stuff, if you're not privy to this type of content or the stats behind it, this is why a lot of the guys, you might not blow an account over 5 or 10 trades, but you do end up blowing your account. It's a slow bleed usually, because although you're risking one and you're profiting, you win 5 trades in a row, you feel like you're, the best ever. That one loss where the contract goes to 0 wipes out all of those and some. Your break-even win rate has to be incredibly high when you're targeting less than a 1-to-1. But like I said, for scalpers or day traders and Discord groups and 0 DTE stuff, you really have to win a lot. And I'll be honest with you, most traders, specifically newer, will not win 85.5% of their trades. It's fucking statistically an anomaly if you find somebody that's new that can do that. And by new, I mean like at least 1 year, probably more. So if you see somebody in Discord or something, they've been trading for 6 months and they're the guru or whatever, that's fine. They're not. You'll figure it out eventually when you bleed an account out and you ask yourself, why am I not getting the same results as this guy? And they tell you it's your trading psychology or your risk management. No, it's fucking statistics. This is a losing way to trade unless you're very, very good at whatever system you're doing. Let's pump this up to 1-to-1. Obviously, your break-even win rate has to be at least 50%. Take it to 2-to-1, which is kind of where most day traders are, right? In between that 1 to 2, you have to win at least 33% of your trades. Seems pretty easy, right? Let's bump it up to 3. You have to win at least 25% of your trades. Let's bump it up to where we start in TTI, 4. Get rid of that. Why? What? I've reached my max number of calculations. Whatever. It's 20%. I was going to keep going on to show you some of the extremes. Your 4-to-1 is going to be a 20% break-even win rate, meaning that you can lose a majority of your trades and still make money if you're targeting these 4-to-1 setups or 3-to-1 or 2-to-1 But when you're targeting less than that, you really fall into this finite group of people that needs to perform at a high level every single day, or you're statistically going to blow an account. So here's my challenge to you guys. And the guys inside of TTI know this. We don't target anything under than 4-1. And I don't have anything against 3-1 or 2-1. It's just that our system in particular, we bat on average. I went through some TraderView stats yesterday and this morning. The biggest winners within our group are all around 45 to 50% win rate. So find a risk to reward model that fits that win rate in order for you to make money. So if you know you're going to win about half of your trades, you should not be taking anything less than a 2-1, but that's theoretical. So let's bump that up to 3-1 or 4-1, or sometimes we find things for 8-1, which I'll show you how to do in a second. And 8-1 requires something crazy. Actually, let's just look at it right now. So on TikTok, it's probably going to be very hard to see this, but it's on my Twitter at How to Swing Trade if you want to find this. Guys inside at TTI got this conversation yesterday, but I think it's incredibly important. So my max loss last year, like number of losses in a row, was 6, right? I was just talking through this morning with a winning trader in TTI. We were going through his stats. He's right now in between 45 and 50% win rate going back. He's been with us for 3 months. So he's right within rubbing shoulders with everybody else that performs reasonably well in TTI. I want to point out that 6 successive losses while 45% win rate. He's profitable, by the way. He's profitable over the last 3 months. He's targeting, he's not quite at 4-1. He's actually a little less than 3-1. So even though he's targeting 4-1, by the time he stops out and closes, he's averaging actually about 2.6-1. So that's something he can work on. And that goes back to me talking about theory. The risk to reward models that you're targeting are theoretical. Very rarely do trades go perfectly. Sometimes you have to take profit early. Sometimes you get stopped out early, etc. Shit happens. So set yourself up for success by targeting the 4-1s. And then if you only get or average 3-1, you're still going to be wildly successful with a 45 to 50% win rate. That's what we do inside of TTI. As a matter of fact, last year, I targeted nothing less than 4-1, and I closed at just above 3-1 risk to reward over my entire year. I was very profitable last year. Was outperformed myself over what I've been able to do over the last 10 years. I'm probably going to revert back to the mean this year, which is totally okay. But I was batting for 4-1 setups or more. And by the time I got around the bases, all of my trades combined were about a 3-1. So once again, aim for a little bit past what you want and factor in there's going to be some fuck ups along the way, if you will. But going back to this max consecutive loss, if you look at this, TikTok trying to point out here, 72% chance over a 50 trade period, if you're a 45% win rate, that you're going to lose 6 fucking trades in a row. 6, a 50% win rate, that 6 goes to 51%, meaning that there is an overwhelmingly large amount of probability that you are going to lose at least 6 trades in a row over a 50 trade period. Most traders would internalize that and go, I'm an idiot. I don't know what I'm doing. This system isn't working. The market sucks, blah, blah, blah. But when you look at something like this, a statistics matrix, you realize that it's totally within reason that you're going to hit that type of drawdown at some point over a 50 trade period. As a matter of fact, how about over a 100 trade period, which is where inside of TTI we have benchmarks, 25, 50, 75, 100. Each time that happens, people come to me, we look at their stats, we adjust things that need to be changed, but it goes into 25 trade chunks. At 100 trades, which you will take inside of TTI this year, you can reasonably assume around a 45% win rate that you're going to hit 2 losing streaks of at least 6. It's going to happen. And so what we're going to focus on here in a little bit is how you can position yourself to be able to ride through those consecutive losses without losing enthusiasm and without losing the ability to move through the market and take the trades that you need to take as they show up. But once again, if anybody is sitting here saying that they don't lose consecutive trades, it's statistically fucking impossible. Seriously. Even if you have win rates up to 80, 85%, 4 losses, 3 losses in a row, like if you're targeting less than a 1-1 setup and you need that 80 to 85 to 90% win rate and you lose 2 or 3 of these in a row, which is a statistical, meaningful number, you're in fucking rough shape. It's important to understand that everybody wants to sit here and say, you know, I'm a big winner and I win everything and blah, blah, blah. Eventually you're going to draw down. How can you manage that drawdown? Are you positioned appropriately for it? Great place to start there with that risk to reward matrix, the break-even win rates, the idea between higher risk to reward, lower risk to reward. I will say that although we favor higher risk to reward setups, 4-1, etc., It does not necessarily mean that this is the only way to make money, right? I'm not going to shit on people that have a system that makes money targeting lower risk reward setups. That's not my goal. At the end of the day, if you're making money, fuck what everybody says. It really doesn't matter. But what I will say in this first part of this webinar is be very wary of marketers that have high win rates with big wins, because it doesn't make any sense mathematically. Either like account size wise, they should be trillionaires within the next 6 months, or they should statistically blow a fucking account if they hit one of these drawdowns, if they're going that big in each position, right? All right, so the next part, see if people said anything. Back to TikTok. I'm trying it. You piqued my interest. I don't know how many people are in there. Probably 3, because I never go on it, but that's fine. Okay. I don't think anybody said anything on Twitter. So let's go ahead and let's move on to entry stops and take profits. So we're going to use, Krista's in here. We're going to use a trade idea that Krista came up with. So everyone's fully aware. We have 2 separate services now that are being offered in TTI. We have the Market Research Bundle, which is a quarterly membership that gives you access to basically all the content we put out. Let's see here. It's this portal, the Circle portal. So all the trade ideas, all the premium newsletters, strategy sessions, markets in focus, everything that we do, webinars like you see here, private webinars, playbooks, whatever, it's all there. But also we have a 1-year trader development program. That's what Krista's in. And Krista went through and found app. Now let's talk through app really quick. This is a trade that I'm very excited for. The guys in TTI were making fun of me earlier today. It's very rare that I get super stoked for a trade. Generally don't want to be super stoked for anything because, man, I don't know if any of you guys have been super stoked on a girl before when you're 17, 18 years old, but they can rip your heart out pretty good and leave a lasting impression. So I'm cautiously optimistic about this trade. All right. App. Don't know what the fuck it does. App Lovin'. It's a mid-cap software related name. She pointed this out about 2 to 3 weeks ago, maybe a little longer. I'm going to remove this risk reward model because we're actually going to talk through it. We got the breakout today. I'm not going to take any time talking about the actual setup, just telling you that we like it. But I want to show you something. The difference in being able to tighten stops while keeping the same trade idea and how it can skew risk reward in your favor. So if you ran the original trade the way that the fib extensions say you should almost always have a 3-to-1, like 2.8 to 3-to-1, depending on exactly where everything is. I know the math is like 2.891. Don't fucking kill me, but a little bit of wiggle room there, right? So we were just talking about how minimum you want to target, at least from a swing trading perspective, is 3-to-1, but generally better to target. You will almost have a perfect 3-to-1 setup if you are longing the 1 area, if you are taking profit at the 1.618 area, and you are stopping out at the 786 area. Almost every single time. It is every single time. You're going to have 3-to-1. So that's a little cheat sheet. If you're targeting 3-to-1 setups, you can run those fibs to the T. Now, that's the base case. That's where we start with our idea. So something like app broke out today, and we wanted to grab it. A couple guys did grab it. They either front ran it earlier this week or they grabbed a partial size today. But what we're looking for in TTI is a pullback. High volume breakout. You guys know the drill. It's the BRB setup. From the original entry, take profit and stop, we have a risk to reward model of about 3. So essentially what you're telling this specific trade is that if it fails on this breakout and pulls back, you're stopping out at a logical level mathematically, and there's previous support area, bottom of the range, to verify that that would be a range breakdown. You don't want anything to do with it anymore. If it continues on up, that's a great trade. Good job. You're risking $1 for every $2.96 that you're going to get back. It's not bad. We were just talked about why that's actually pretty good. But inside of TTI, we would prefer to buy pullbacks after names have already broken out because it dramatically skews the risk to reward. And let me tell you why. A trader that bought the breakout would be more willing to hold that breakout through a pullback towards the stop out area because the stop is already on the books. Very rarely do you see a trader put a stop like right here on the initial breakout day because generally speaking, the very next day you get the pullback. So a lot of the breakout style traders are going to defend a stop based off of a logical point in the range that they're buying the breakout or some sort of fractal that they're buying the breakout. We're running math because it's just the fib extension. So once again, around a 3-to-1 setup. Now, when I tell you that there's a 66% chance of a pullback within the next 1 to 3 days on app, does that skew where your stop is going to be? For us, it does. The original trade buying the breakout here would be down here at 37.5, something like that. It would be around a 3-to-1 setup. But if we're looking to buy the pullback, which is statistically in play now, like I said, 65%, 66% actually, of the time you get that pullback down there, what we can do is buy the pullback in towards the original breakout area, and we can tighten the stop somewhere right here, and we can say, we want to own this as long as it's bouncing. If it falls back underneath the range, we want nothing to do with it. We are getting a better entry point than the guy that bought it on the original breakout. We're getting cheaper contracts if you're buying options contracts because we're buying them on a pullback and premium gets crushed. And we're going to raise our stops to say if we don't bounce, we want out. It's the same trade idea, same entry, same take profit, but the stop is manipulated based off of what the actual price is doing at the time of entry. If we don't get the bounce the very next day, we're out. By tightening the stop, the same trade idea goes from a 3-to-1 to, in this case, I just right off the cuff, I don't know if this is exactly the trade that we're going to take in TTI, but it's a 10-to-1. Now all of a sudden, it's the exact same trade idea, but you're buying it on the pullback instead of the breakout. And you're skewing that 3-to-1 to a 10-to-1. Now, the odds of the 10-to-1 playing out over time are lower than the odds of the 3-to-1 playing out. A tighter stop generally gets stopped out faster. That's how this stuff works. When it doesn't get stopped, you make a lot of money. So this, in particular, 10-to-1 setup, statistically is going to lose quite often. But when they hit big. And there's no better example than Meta. We have traded Meta 4 times in the last 14 months, and all of them have been fucking huge. This has been probably the biggest single winner that we've traded in TTI going back to 2023. The last ad that we had on Meta was at 315. That was the ad, 315. And we said if it stopped below 305, we didn't want anything to do with it anymore. And we were 380 to 390 at the time. That is a 7-to-1 risk to reward. And I want to point something out. It came back and tested our entry. Did it feel good to hold a contract or a position in general that was up at one point, nearly 10%, 8%, all the way back to entry before bouncing and continuing on up? No. But by having our stop as tight as it was, we knew that odds were against us to begin with that this was even going to play. And yet it did bounce exactly where the entry was. It never came down to 305. And on a break back up and over 340, we immediately moved our stops up, not only to break even, but into profit. And now, if you've been following any of our content on Twitter or whatever, you see the fruits of the labor. I think he's probably in here right now. We have a trader named Dustin. He's up 40 grand on this trade from the November entry. Billy, 500% plus winner on the November entry. As a matter of fact, I'll show you the exact call. Watch this. November 2nd of 2023. Here was the chart. That's where we were. Risk on above, 305, risk off below 285. So a little different. But we were able to hold through the pullbacks because the R to R was on our side. All right? So being able to move and manipulate the stops based off of whether or not you're buying the breakouts or the pullbacks, etc., matters a lot. If you guys have any charts that you want me to go through, feel free to post them now and I'll try to pull it up and see if there's ways that we can manipulate that stop. We don't want to change the entry. We don't want to change the take profit. We want to manipulate the stop because remember, let's go to a different trade, AMD. We're in AMD as well. You should be stopping out where the trade idea becomes invalidated, not where the percentage loss is. That is a product of position sizing, not of stopping out. You should, as a technical trader, stop out of a trade when the trade becomes invalidated, not a percentage loss. If the percentage loss is too great, where the trade idea becomes invalidated, what do? You lower your position sizing. If you're trading based off of price action, off of charts, etc., you need to take into account all pertinent information, and that includes the stop out. You don't just get to randomly make one. AMD is a good example. We bought the pullback on the all-time high breakout. We had a stop right underneath it. It's a 9.5 to 1. We're in this. This is a trade we're in right now. It's up rather large for us. It's free, actually. We were able to get out of it already. So we had a complex strategy to play this. We sold put credit spreads, and then they ended up more than, I think the very next day we sold them for 65%, which was able to give us an absolutely free position on the books for the call debit spread side. These were up and over on 100%. We took a little bit of profit. So this is a completely free plus profitable trade into all-time high. But the original setup was a 9.5 to 1 risk to reward. Statistically, these things don't work out very often, but when they do, it's fucking huge. You don't need to hit very many of these to make a year. Something that Pradeep Bond Stockbee on Twitter talks about all the time. Hit singles until you can afford the home runs and then go deep on them. Tight stops, swing for the fences when the stars align, which is exactly what we did. Okay. You can be wrong up to 90% of the time and still be profitable. You're right. And hopefully you're not wrong 90% of the time, but I can give you a great example of somebody that is and is still wildly profitable. Let's go back to this risk to reward matrix just for a second. Jason Shapiro with Crowded Market Report. Love the guy. He is a contrarian trader by heart, and he does not trade based off of technicals. He trades based off of something called the Commitment of Trader Report. And what that does is essentially shows you positioning from market participants, large speculators, commercials, etc. And he's essentially looking for overweight parts of the market that potentially could fail, and he wants to take the failed trade. He calls it a news failure trade. But it's all set up by this idea of trading against the trend. He looks where is everybody long? Maybe that's an area where I should be looking to short. I'm simplifying it, but I want to tell you something. Generally, his trades, if you read the Unknown Market Wizards books, there's a whole series on it, but that one in particular came out in 2020. He's in it. He talks about batting like 15 and 20 to 1 risk to reward. So for $1 he wants to make 20. That is insane. Because your win rate is going to be like 5 to 10%, meaning a majority of the trades he takes by a wide margin are not going to manifest themselves into anything. They're going to be smaller losses over and over and over and over and over. The statistical chance of a 10% win rate hitting 11 trades losses in a row is 100% over 50 trades. Like, it's going to happen, statistically speaking. So he's totally okay with losing. And I'm not just using him. He's a phenomenal trader, and the way that he trades is fucking awesome. But it's not for everybody. And that's totally okay. And there's other traders as well. The Unicorn Sniper or something inside of Unknown Market Wizards. He focuses on like huge risk to reward as well, and his win rate is less than 20%. But once again, it's all about risk to reward. And absolutely right, you can be wrong up to 90% of the time and still be profitable as long as you're targeting the right risk to reward model. And by the way, high risk to reward models are harder to find. So it's going to be easier to find a 1-to-1 than it is going to be to find a 4-to-1. It's going to be easier to find a 4-to-1 than it is to find like a 20-to-1. That's part of the unfortunate part of it. You have to go hunt the higher R2R setups. They don't just show up all the time. So let's talk really quick about options. This is risk management principles. So we're going to talk about options a little bit here. Now, I might hurt some of your guys' feelings when I say this, but that's okay. I'm used to it. You don't necessarily need to use a stop loss when you're trading an options contract. I know. Sounds crazy. But I'm going to tell you something. There's an entire world of options traders that does not exist on Discord that have been profitable for 20 to 30 fucking years. And they don't have weird fucking names on FinTwit and have an NFT as a profile picture. One of the best edges in trading options, one of the biggest competitive advantages, is the simple fact that you can go out in a low IV environment. Let's use Tesla because Tesla is a low IV environment right now. I'm not saying Tesla is going to go up today. Not saying it's going to go up today. Let's clear the order. But it's a low IV environment. Less than 50 IV, 0.2 IV rank, meaning that over the last 52 weeks, this is the lowest IV it's ever been in Tesla. Let's go out to the Junes, just randomly choosing a contract here. Let's say we're bullish Tesla and we want to buy the 0.25 delta, generally pretty okay, $245. What is the max loss on this contract? If you were to take one contract, it's $650. It's the debit that you paid today to get into the trade. Now, I will tell you right now that I do stop out of options trades, so I'm going to present both sides, and you can make an educated decision on whichever one you fall into, but I want to point out that neither of them have any statistical edge over the other that I have found yet. I have traded both ways. I'm more comfortable taking stops because of my equities background. One of the greatest competitive advantages for trading options where you pay a debit is that you cannot lose any more than the debit that you paid for the play. So let's take a step back and say you are willing to risk $500 on a trade. That's it. You're not willing to lose anything else. And by the way, when you take a trade and you say, I'm willing to lose whatever, you should immediately assume that you are going to lose all of that money. And if that is a punch to your gut, you are risking too much. Size down. So if you say, I'm willing to risk, in this case, we'll say $650, the built-in stop loss, the built-in protector of your account capital is the premium that you paid. You don't need to stop out if you don't want to. If you're 1R, which we're going to go through in a second, your max risk is only $650. You just paid $650. You don't need to stop out. You can let this thing expire worthless and it still technically hits your stop. That's it. There are plenty of professional options traders that never stop out of a single fucking options play. They just let them expire worthless because the premium they paid to begin with is the amount that they're willing to risk to begin with. So it makes no sense to them. Now let's talk about some of the pros of that. The pros are something inside of TTI we call zombie contracts. We have a couple guys in TTI that are exemplify this idea. Where we're in a trade, it doesn't work. A bunch of us stop out, including myself. They leave the trade on their books because the debit that they paid is their stop loss anyway. So they essentially just wait for these trades to fall off, worthless. But then the next market oscillation shows up and they get out of a trade at break even, or they get out of a trade in a profit. We call those zombie contracts that come back from really far down back up to break even or profitability. That's the opportunity cost of stopping out. Now, I'm not saying that's good or bad. I'm just saying it happens. And we've seen some pretty big wins come out of zombie contracts. We've seen multiple 100% wins. We've seen contracts go from negative 90 to positive 500%. Doesn't happen always. As a matter of fact, it's a very small amount of the time that happens. But by stopping out early, the opportunity cost is you'll never be able to have that type of play where the market comes back for that particular trade and all of a sudden you're back up into profit. It happens. I'm sure some of you guys have experienced that on accident. But it generally doesn't happen. So it's a very low statistical, and you should not expect it to happen. Once you realize the trade is dead based off of the chart, you should throw it into a category depending on your brokerage software and just collapse the tab and just wait for it to expire worthless. And if it starts to come back up, great, move it back in and manage it. But generally, those are like the zombie land area. It's a graveyard of expirations. Now, the way I do it is completely different. The way I do it is I stop out based off of the chart. So if I go back to TradingView, for example, and let's say the AMD play that I'm up, I buy it the very second day that it pulls back, right? It breaks out, then it pulls back. I'm buying the pullback. I want to stop out at a pre-decided position on the chart that says this particular breakout is no longer statistically in my favor. I want out. I typically will close anywhere between 25 to 50% at a loss. Now, the way I rationalize this is that I took the same risk as the guy that's letting the entire thing go to zero, but I'm getting a rebate. The trade idea is dead. I'm stopping out. Let's say I paid $500 for the play and I lose 50% of it. I'm getting $250 back to go and place into a new trade idea. We call them rebates. Now, I ran the experiment in 2022 of stopping out of trades because we ran the experiment. Which one was more profitable? Letting zombie contracts lay on the books until they expire worthless or stop out? And it goes against all like what you're going to fucking listen to on YouTube. Use a stop loss. What people don't understand is there's a built-in stop loss on options already, right? This is like an old school equities way of viewing the market, that you need a stop loss on the books. You don't need one from an option standpoint. So we ran the test with real money. And what I realized in 2022 was I come from an equities background, so I do enjoy stopping out. I saved thousands of dollars. I didn't have a very big options account in 2022. I'm relatively new still. Started trading options in early 2021 after 12 years of equities, right? So I built up my options account. What I realized over the course of the year, I saved thousands of dollars on stopping out that probably would have expired worthless. The catch, though, is I gained virtually nothing on any of those trades that I stopped out of. So it's a catch-22. I don't know which answer is the right answer. I still prefer to stop out. But if someone tells you that they don't know what they're doing because they don't have a stop on the books when they paid a debit to get into an options trade, it's just fucking wrong. The stop is built into the premium that you pay. Let's talk really quick about going through and finding risk to reward on the chart. So this is a hot topic specifically for newer traders. Don't know what you're doing. Call debit spreads are fantastic for two reasons. One, they're generally cheaper, and two, they hedge against a bunch of the Greeks. That's like your two biggest edges. Number three, which I would think is probably the best, is that you can clearly define your max risk and your max loss from the very beginning, so you know exactly where you're sitting in terms of risk to reward. So once again, they're cheaper, they hedge against some of the Greeks, and you know exactly your R to R. Let's use the Tesla contracts again. And what I want to focus on is how can we find a 4-to-1 setup, right? That's what we were talking about. Let's say we're bullish Tesla. We're looking for a 4-to-1 setup. I'm not going to go through all of the Greeks, but we generally try to focus on the 0.25 delta. It statistically performs well for the time frame that we trade in TTI, that 45 to 120 day window. We generally start about the 0.25 delta. What we can do from a call debit spread standpoint is we can, for example, buy the 245 and sell the 246 and see what type of risk to reward we're going to get on that. As of right now, this is a massive risk to reward, so we're actually going to use a different one. Let's go to the 250s. A little bit more realistic. If you were to buy the 245 and sell the 250, and this is just randomly picking contracts, your max loss is 74, and your max profit is 426. Simple math dictates that's about a 5-to-1 setup. 6-to-1 setup. So your call debit spread is telling you right off the bat, for every $74 that you put into this specific trade, you can expect a max profit of at the most 426, which is a 6-to-1 setup at full profitability. You have a 69% chance that this thing is going to move 50%, and you have a 19% chance that this is going to expire in the money. Actually pretty fucking good. Pretty goddamn good, actually. It's a 6-to-1 setup on Tesla, and we just randomly chose contracts. Let's go out to Meta, since that's the hot trade right now. Let's go out to June's. The 0.25 delta, so let's buy the 475 and sell the 480. What does that say? Once again, we're targeting the 0.25 delta. Max loss is 100, max profit is 400. There's a 4-to-1 setup. Once again. Now, what you want to do from a technical standpoint is go and make sure that the contracts actually make sense. You're not just going to go find a 4-to-1 setup and buy it arbitrarily. We have a long system in place, and this is step number 4, by the way, the options contract chain. Like step 1 and step 2 take about 95% of it. We have 2.5% in charting and 2.5% in options contracts. So there's a big, long process behind this. But if the strike prices make sense where the take profit price is on the chart, this is your 4-to-1 setup to trade. Let's do it on a name that I haven't looked at. I don't know, App. I have not looked at App in terms of call debit spreads. I don't know if this is going to be a 4-to-1 setup, and I can tell right off the bat because this is a 0.33 delta and a 0.25 delta. We are looking at buying the July 19th $65 calls. So if you're watching this, there's a little bit of alpha for you. Tomorrow on a pullback, we want to own the $65 calls in July for under $2. They're currently trading $2.25. There's your little tidbit for the night. I don't think this is going to be a 4-to-1 setup, but we can go ahead and try. It is. Max loss 93, max profit 407. So it's not like $2 is incredibly expensive, and you probably want to buy calls here because it's a low IV environment and you get to make money off both the IV expansion and the direction of the price. But for whatever reason, if it's too expensive, you now found a cheaper way to get almost the same exposure while only paying $93 instead of $2. Max profit of 407. It's greater than a 4-to-1. See where I'm finding these though? Using spreads, call debit spreads, put debit spreads, you can figure out your R to R prior to even taking the trade. So if you're going to target, you have a smaller account, you want to target a specific risk to reward model, you already have the trade charted out on the chart, there happens to be a play on the chain that makes sense, double check that it's a 4-to-1, 3-to-1, whatever you're trying to target, and then run it. See how that works over 25 to 50 trades. I bet you surprise yourself. So the last thing I want to talk about and open it up for questions is the concept of position sizing. There's no one answer fits all. Let me grab a drink here. And this can drive people insane. Most people are going to tell you don't risk more than 1% of your account. They're fucking idiots. No one's going to listen to that. Nobody listens to that. As a matter of fact, the United States investing champion of 2023, God bless him, I can't remember his name. It's a very Indian name. I can't remember it off the top of my head. He outperformed everybody by magnitudes. I think he ended 2023 up 850% on the year on his account. Day trading, by the way, which is incredible because last year was definitely a better year for swing trading than day trading. We had a trending market and it fucking performed well. So to outperform swing traders in a year like last year is not enough respect is put on that alone. His overall thesis of how can you make that much money was that you need to use significant portions of your account. That's it. Like, he was not risking 1%. He is not a portfolio manager. He does not have mom and pop's money. He is not working for some place that has compliance. He's a retail trader that is allowed to take larger risks on the account. And let's be honest, and just be honest with yourself, nobody fucking does that. Nobody does that. So if I were to sit here and preach to you from an ivory tower, only risk 1%, and if you're inside of TTI and you blow an account, and if I ever tell you, you only should have risked 1%, please know that somebody's holding a gun to the back of my head because I know it's not feasible. It's not going to happen. So let's talk about it a different way, a more logical way, a way that actually makes people understand right off the bat how much you should be looking to trade. And this comes from Josh Answers, the trading fraternity. I learned this, or I heard it the first time from somebody that came into TTI that had been watching Josh Answers on YouTube during 2020. And I loved it. So Josh, I don't know if you'll ever hear this, but fantastic comparison. He said, listen, how much would you be willing to go out and spend on a Wednesday afternoon and not like stress about it? $200, would you go buy a new pair of sneakers for $300, $200 on a Wednesday? Yeah, not sweat it. Cool. If you're going to buy a $200 to $300 position, no problem. But if you start sweating about $300, maybe you should think about sizing down. Because we all know, and this video isn't about emotions, we all know that quote unquote trading psychology, which is such a bullshit cop-out thing for people to market, but they don't really ever tell you what it is or how to like get around it or conceptualize it or anything. There's regurgitate YouTube clickbait shit. But let's be honest, once you start sweating with a lot of money on the line, your decision-making process goes down the drain. Trading, outside of trading, it doesn't have to be in the markets. As soon as there's a lot of money on the line, which is relative, by the way, we have guys in TTI. We have a trader right now. I just referenced this. Dustin has 40 grand profit right now on Meta. Can you imagine? I watched his open profitability go from 30 grand to 21 grand, and he held the entire time because the trade wasn't done. What would you do in that situation? To be honest with yourself, if you saw $9,000 evaporate off of a $30,000 position, would you freak out? Most people would. They've never had that big of a position on the books. He's able to work through it. Now, it's not belittling anybody in here. We all have smaller accounts at some point while we're on this journey. But it's important to understand that the overall dollar amount, regardless of what people say, impacts the quality of the decision. So if on a Wednesday you're not willing to go and spend $500 on your girlfriend, on your family, on whatever the fuck it is, don't do it in the market. Position size down. If you're used to spending $100 per date night and that's all you can squeeze out, maybe that's all you should be practicing with when you're taking positions, especially when you're learning a new system. This made so much sense to me because everybody can relate to that. Everybody can relate to that dollar amount that means a lot to them. So instead of me saying, use 1% and only, which nobody does, you say that, you pay some asshole $25 for a Discord, you read through his fucking trading principles and he tells you don't risk more, and you're like, I'm going to risk 50. Right? So I'm trying to give you guys a realistic viewpoint here. Risk how much you're willing to go and spend on a random day without sweating. That's what you should be focused on. Because if you lose it, it's not the end of the world. Your back's not against the wall. You're not worried about paying bills, etc. But now let me move into an advanced topic called R. If you're in TTI, you're probably rolling your eyes. R. Anybody know what R is? Google it if you want. We did not come up with this. It's been a trading standard for years. R means risk. Everybody's risk is different. It could start as simple as how much do you normally spend on a day out, what we just did. If you're in TTI, we generally start you off with even if you have a fucking $1 million account, we'd really try to push you into not trading with the $1 million account when you first start out, because there's going to be some growing pains as you figure out how to actually make money instead of just fucking YOLOing. So we try to standardize this R, and it's different for everybody depending on your experience and your position sizing. But let's say, for example, just to keep math easy, your 1R, which is how much you're willing to risk per trade, is $10,000. That seems outrageous, but bear with me here. Your 1R is $10,000. The way that we can utilize this inside of trading is we can manipulate the way that we enter into trades by saying we should probably not take a 1R position here. We should probably take a 0.25R. Now, in this case, that would be a $2,500 position. But to somebody completely different, that might be a $500 position or a $100 position. But everybody understands that we're legging into the trade at less than 1R, less than one risk point. And everybody's going to be different depending on, once again, your account size, how experienced you are, etc. So if we say 0.25R here, that's what we're rolling with. Everybody has a different model, but everybody knows exactly what their R is and can do the fucking math to figure out what 25% of it is. What happens if the very next day on a pullback, we say we're fully sizing in another 0.7R? What does that mean? On the pullback, we're adding in what? Another $7,500. And that's going to get us into the full 1R position. Now, sometimes we just take the full 1R. Sometimes we break it up more. It all depends on the specific trade setup. But this R concept is incredibly important because not only do you standardize your position sizing, which allows you to go through your stats over a large sample size and figure out if you're doing something wrong, instead of just YOLOing, buying $300 contracts here, and then the very next day you're spending $600 here, which is double the fucking R that you just traded with yesterday, a big no-no. And then randomly you find some cheap contracts for $60, and you're like, oh, I'm going to buy those. Statistically, these are going to never fucking work, but you're still going to YOLO because you're a fucking degenerate. And then the next time there's 1,000, Tesla looks really good here, and then you're buying that. Next thing you know, you have a sample size of trades that are all over, and you blow an account, and you look, someone goes, you should, load your trades into TraderView or something, and you do, and you're like, I have no fucking idea what I was doing. This is bad. Standardize your 1R. Utilize what I was just talking about if that's the easiest way to interpret it. How much are you willing to spend? $300 on a Wednesday? That's your 1R. You are not going to risk more than $300 per trade. And that means going to the options chain and finding something that is no more than $3. Or if you're taking more than one, the overall debit you're paying for the full position is not more than $3. That's it. That's what you're working with. That is your 1R. As you gain consistency and profitability, if you ever do, not to be a dick, the next best step is working on increasing your 1R, which is ironically harder than first establishing and sticking to your 1R. We have a couple guys that have joined within the last 3 to 4 months. A couple of them have exhibited some quality characteristics in trading, and they're now going through their first or second stage of upping their risk. This is more tedious than starting off. It's harder because you know what you're doing in the market, and now it's time to size up. And what were we talking about just 5 minutes ago? The emotional response to higher dollar amounts, no matter how cool you are, is difficult to manage at the beginning. So something we do inside of TTI, for example, if somebody's starting off with $1,000 R, that's their one R. We generally move their 1R up to, we don't double it or do anything crazy. It's just 1,250. 1 to 2 weeks of consistent profitability, stats to back it up, move it up again to 1,500. These might seem like small increments, especially if you have a large account. But next thing you know, within 12 to 16 weeks, your 1R is going to be like 3K instead of 1K. And the difference is if you just went straight from 1K to 3K, every pullback that you're conditioning yourself to potentially hold through because the trade idea is still valid. You don't want to stop out early because you know the trade's still on. If you go from 1K to 3K, you're gonna make some bad decisions and build some bad habits because that's a big jump. But when you gradually ease into it, next thing you know, like I said, 12 to 16 weeks, your emotional response to 3K is generally going to be the same as 1K. Now extrapolate that out even more. It's not a fucking sprint here. I know that everybody wants to get rich tomorrow, but if you pay me a lot of money to sit in TTI, then you know that it's not a fucking sprint. And this is how we systematically step you up to taking bigger position sizing. It all comes back to consistency and profitability. And what I've seen is guys that double and triple their 1R because they've hit a win streak generally fucking blow it all. You have to condition yourself emotionally to be able to wield this type of stuff. So this concept of risk is very important. For those of you that are advanced, you kind of already know where you're sitting. I challenge you to standardize your risk. Use the concept of R. Say 1R. Like say it to yourself. I'm 1Ring into this trade. I have 1R in this trade. It will help. And then when it comes time to scaling up, you can Google this. I'm not the asshole that came up with this idea. As a matter of fact, S&B Capital is a big influence on me. They have risk managers that talk to their professional prop traders on a weekly basis, and they size them up. We do the same thing in TTI. I'm not making any money off it, unfortunately, but we want guys to size up logically. So hopefully they don't blow a fucking account going from 1K to 10K, for example, which not inside of TTI, but I've seen happen. Last thing I want to talk about really quick before I open it up for questions. I think I have about 8 to 10 minutes left before I'm going to go eat dinner. It is currently 10 p.m. in Brazil, and I'm fucking starving. We're going to talk about how to manage stops in equities and options. I shouldn't say stops. It is stops, I guess, but it's a different concept. We utilize volatility a lot in our trading, as most of you probably should. It doesn't necessarily have to be a main component, but you have to be very aware of the volatility of the name that you're trading because that allows you to set expectations for the trade. If you're trading a highly volatile name, maybe you position size down a little bit with a wider stop. If it's a lower volatility name, maybe you position over a little bit with a tighter stop. Think low beta versus high beta names. Think growth versus value, etc. This is a mid-cap software-related name that we're trading, GitLab GTLB. Here's the full setup. It's a basic stage 2 breakout with a classic Stan Weinstein retest of previous resistance now turned support and a 200-day moving average sloped up. Classic stage 2 uptrend. Mr. Stan Weinstein's stage analysis cycle. So we're long this. From a shares perspective, let's say you got in on the retest at 58.75. What we're looking for in terms of volatility to move stops up to break even is a 2 times ADR move to cover our entry. What does this mean? What is ADR? ADR is average daily range. It's not the only volatility indicator out there, but it's one that we like to use because it allows us to understand on any given day what is the average high to low price swing on a stock. In this case, GitLab moves 4.25 from peak to trough per day. That's pretty volatile. So from peak to trough on any given day, on average, this thing's going to move 4.25. So what we say inside of TTI is if we're buying a pullback or a breakout, doesn't matter which one we're doing, that if this thing moves 2 times or greater, more than the average daily range in the direction that we want, in this case up, we want to cover our stop because it generally means that the trend is going to continue in the direction that we are trading. So a 2x ADR move in GitLab would be 4.25 times 2 or 8.5%. At 8.5% from our entry, we want to move our stop to take profit. Now we have guys in GitLab, both shares and options contracts. So this is a real trade we're in. And I'm just going to shift click up. It's not going to be perfect, but you'll get it. 58.75 we'll say is the entry. And we want to move it up at 8.5. There was the stop that we moved. Once we closed up 2x ADR, it gives us enough wiggle room to move our stop up and cover the trade for free. This effectively removes all principal risk from principal on the trade unless we get some sort of gap through the stop, which it's impossible to fucking plan for that. Generally doesn't happen, but when it does, it sucks. So by immediately moving stops up off of a 2x ADR move, you can reasonably expect to stop out at the very worst break even. In this case, this trade is up after hours 26% from our entry in terms of shares. 1R is not one port, please. But I will also say that 1R is not 1%. We're not portfolio managers with like 100 names under our belt. It's ridiculous to think that that's the way that people are actually trading in the retail world. Our greatest edge in retail is having unbridled access to as much risk as we want. It's just too many assholes don't use it effectively. Like they full port a really bad trade and then they wonder why it never works. You won't find hedge funds full porting anything. You won't find portfolio managers full porting anything, right? Like there's a reason why, for example, the USIC trader full ported like 4 or 5 different times throughout the year and was up 800+%. You don't get that with just little slivers of risk. You have to risk to make money. It's part of the game. You have to be able to risk. So GitLab, well up and over our initial entry +2 ADR move. This was a break-even trade. We've been able to hold through the consolidation phase. It's up about 26%-ish from our entry. Great shares trade. But let's look at it from an option standpoint. Yeah, I can show it. I think it's on here. Here's the GitLab trade when we first took it. We were not necessarily taking it there. We were prepping to take it, but it was back in December. That's how we were able to grab it. That's what the chart looked like then. And this is what it looks like now. So you can see exactly what we were looking at. Okay. The trade itself, the contracts. I'm going to give you guys probably the best piece of advice I can give in terms of options trading, that you cannot lose more than the debit that you paid. You can effectively position size yourself well while sleeping well at night. If you don't want to lose more, don't put more than $300 into the fucking trade. You'll never lose more than $300. It's really that fucking simple. The second biggest competitive advantage in my mind, other than just being able to feel fucking great when you're up 1,000%. You're never going to get that in a shares trade. But realistically, the second best competitive advantage is the fact that we can cut the positions at 100% profit and turn it risk-free on principle, which is what happened with GitLab. I don't have the goddamn contracts up. I wish I did. I should have dug through Discord before this webinar. But Brian, for those of you in TTI, you saw this today. Brian was in some Marches or Aprils, I don't remember. And he was able to sell more than half of his position today at over 100%. What does that do by selling half of your stuff? So let's say you bought the $90 calls. I'm just spitballing here. Actually, we can look at let's go to the 0.85s and actually do a little bit of digging here. If you don't know what I'm doing, I'm looking at the pricing history of the contract. This is a great way to be able to tell if the person you're following on FinTwit, TikTok, YouTube actually trades what they say they trade. You can actually go and look at the size. So if they're trading some bullshit obscure ticker that they say they have 1,000 contracts in, you could just go verify that. But anyway, going back and looking at this GitLab contract, at one point it was going for $1.10. Let's just say you bought it at 2 p.m. January 18th for $1.10. Just throwing it out there. It's now going for $3.10. The way that we do the stop loss management inside of TTI in terms of moving trades up like we do in equities is that at 100%, we close half of the trade that we have originally purposed, or that we had originally bought, in order to remove all risk from the trade principal-wise. The only thing that you're risking at that point is unrealized profits, house money. So the sooner we can turn a trade free, the faster we can stop worrying about managing or over-managing the trade on an intraday or even a day-to-day basis. We can let that trade breathe, knowing that the only thing we are risking at that point is house money. Selling half of your contracts at 100%